Understanding support and resistance levels. The key to smarter trading. Master the fundamental skill that separates successful traders from the rest. Support and resistance levels are the invisible architecture of price movement. Learn to see them, and you'll unlock a powerful edge in any market. What are support and resistance? Support, the floor. A price level where falling prices tend to stop and bounce back up due to concentrated buying interest. Think of it as a safety net that catches declining prices. Resistance, the ceiling. A price level where rising prices tend to stall and reverse downward due to selling pressure. It acts as a barrier preventing further upward movement. These levels act as psychological floors and ceilings shaped by the fundamental forces of supply and demand, where trader sentiment creates predictable patterns. Why support and resistance matter. Psychological barriers. These levels represent collective trader psychology, where many participants place buy or sell orders, creating self-fulfilling prophecies in the market. Strength through testing. The more times price tests these levels without breaking through, the stronger and more reliable they become as decision points. Role reversal. When broken, these levels often flip roles. Former support becomes new resistance, and former resistance becomes new support. A critical concept for trade entries. How to identify support and resistance levels. 1. Historical price points. Look for areas where price repeatedly reversed direction, peaks and troughs that appear multiple times on your chart. 2. Round numbers. Psychological levels like $50, $100, or $1,000 often act as natural support or resistance zones due to human preference for round figures. 3. Swing highs and lows. Previous swing highs and lows in trending markets serve as dynamic levels that shift with market momentum. 4. Technical tools. Use trend lines, moving averages, Fibonacci retracements, and pivot points to mathematically identify key price levels. Drawing support and resistance lines. Connect multiple points. Draw resistance by connecting multiple price highs and support by connecting multiple price lows. The more touches, the stronger the level. Think in zones. Treat these as zones rather than exact lines to accommodate normal price, noise, and wicks. A zone approach is more practical and forgiving. Multiple timeframes. Use multiple timeframes, daily, weekly charts, to identify stronger, more significant levels that institutional traders respect. Trading strategies. Using support and resistance. 1. Range trading. Buy near support and sell near resistance within a sideways consolidating market. Perfect for choppy conditions with clear boundaries. 2. Breakout trading. Enter trades when price decisively breaks through support or resistance with strong volume confirmation, signaling a new trend. 3. Trendline trading. Use diagonal trend lines as dynamic support or resistance to trade with the dominant trend, entering on pullbacks. 4. Moving averages. Popular MAs like the 20, 50, and 55 period averages act as dynamic support and resistance that move with price action. Real-world example. Support becomes resistance. Step 1. Support breaks. Price breaks below a strong support level after multiple failed tests, indicating weakness. Step 2. Retest phase. When price retraces back upward, the old support zone now acts as new resistance, a critical moment. Step 3. Trade entry. Traders use this flip to enter short positions with clearly defined risk, placing stops just above the resistance, confirming trades with price action signals. Increase your probability of success. Reversal candlestick patterns. Look for pin bars, engulfing bars, and doji formations at key support or resistance levels. These signal potential reversals. Volume confirmation. These price action signals dramatically increase the probability of a successful bounce or breakout when combined with volume spikes. Risk management. Always use stop loss orders placed just beyond support or resistance zones to protect your capital and define risk clearly. Common mistakes to avoid: treating levels as exact lines. Support and resistance are zones, not precise lines. Price can wick through levels without invalidating them. Think in ranges, not pinpoint accuracy. Ignoring volume and confirmation. Breakouts without volume are often false signals. Always wait for confirmation through volume surges and follow through price action. Disregarding market context. Trading support and resistance without considering the overall trend and broader market conditions leads to low probability setups. Over-relying on indicators. Indicators are helpful, but understanding raw price action at key levels is far more important than any secondary indicator reading. Slide 10. Mastering